Welcome to the TrestleBridge Capital Market Observations Call for the week of April the 3rd, 2023. I'm your host, Eric Jefferson, Managing Partner with TrestleBridge. And for today's call, we're going to spend some time going through the first quarter's performance. Here we are through the first 3 months of the year. Going to recap what took place, what were some of the highlights, the themes. We'll touch on some of the collateral as well you can expect from us in the days and weeks ahead. Then we can preview some of the major items on the radar for the upcoming week. Before we get started, though, have a few quick words from our legal team. With that, we can go ahead, dive right in. By all accounts, risk assets had a very good start to the year, despite an incredible amount of volatility, had some very violent swings in both stocks and bonds, but ultimately at the end of the day, the S&P 500 ended up about 7.5%. We saw bonds measured by the Bloomberg U.S. aggregate up about 2.5%. By all accounts, a very good very good start to the year, rather, for those. Interesting theme, though, as we sort of go a layer underneath the surface. When we think about different types of stocks, there's a way to categorize different sectors, different styles, different sizes, but one of the things we can do in the investment universe is analyze a company, looking at things like earnings and profitability and growth, and looking at how well its balance sheet is constructed, all of these fundamental attributes, and then be able to categorize companies based upon whether they have high quality or display low quality. And interestingly enough, companies with very, very strong fundamentals, the first 3 months to the year, virtually flat, up 0.5 percentage point, in contrast to companies with very unattractive fundamentals that were up over 15.5. Furthermore, when you think about all the experts on Wall Street, the teams of very, very smart, very, very well-resourced people that analyze companies day in and day out, trying to identify what are the companies you want to own? What are the companies you want to avoid? And when we look at companies that had an aggregate buy rating, so classified as companies that the sell side would suggest you would want to own on a year-to-date basis, so for the first 3 quarters of the year, down over 12%. In contrast to that, companies that the experts have gone through, have analyzed and suggested or reached the conclusion that you would not want to own, or rather you would want to avoid, those companies up about 4.5%. So again, a 17 percentage point delta between companies that have very attractive fundamentals that you would want to own versus those that you wouldn't. Now, when you compare that to last year, we saw virtually the opposite. It was those higher quality companies that outperformed by nearly 20%. And so when we think about what has really accounts for this year to date, arguably the biggest driver has been the expectation that interest rate cuts will be coming at some point later this year. And from the seat I sit, I would certainly agree. If you believe that interest rates are coming down, not necessarily a bad time to establish positions in some of those companies that have been truly, truly beaten up. Not surprisingly, that expectation for lower rates has also fueled or been the catalyst, rather, for positive bond performance. That obviously very much a headwind going back to 2022. However, from the seat that I sit, there is a huge disconnect between what the market is currently pricing in or what they're anticipating versus what the experts at the Federal Reserve are telling us they are going to do. Chairman Powell, for all the critique and criticism he has received, has been very transparent as of late, does not anticipate any cuts coming anytime soon. So right now, we have a very glaring disconnect where somebody has to be wrong. And if we think about what ultimately will dictate the path of interest rates going forward, that has on one hand, component with inflation. Inflation is still high, still very sticky. Obviously, higher rates are used to combat that or bring that down. On the other hand, we have a very strong labor market. Unemployment still near all-time lows. Obviously, higher interest rates at times tend to increase unemployment by slowing the economy. have not really seen any meaningful signs of that as of yet. So when we think about all of the recession talk that's been out there and the announced layoffs, that for the most part has by and large been concentrated in the technology sector. There's not been a widespread trend occurring throughout the overall market. And so when we think it, just the economics currently in place, when we just look at the data, by all accounts, most Econ 101 students would look at the scenarios in place and come to the likely conclusion that if interest rates go anywhere, potentially could go even higher. And so where we have such a glaring disconnect between the markets and what the experts are telling us, that to me, somewhat of a cautious environment out there, not one where I'd be looking to take above levels of risk. Now, granted, you would have been rewarded had you done that over the last 3 months, although going back longer term over years and decades, clearly it is those higher fundamentals that tend to work in your favor more often than not. That being said, no process is perfect all of the time. The first 3 months of the year, clearly an example of where you can have a disconnect between the fundamental environment and what market participants ultimately reward. As we shift more narrowly into last week, a key headline, we've seen oil prices up about 10%. That was a function of some of the largest oil manufacturers or producers agreed to cut supply. That doesn't have a positive connotation to it for two reasons. One is typically they're doing that in anticipation of slowing growth, possible recession. If less oil is going to be consumed, they would like to bring less to market, so you don't see prices meaningfully decline. Additionally, going back to the last concept discussed, if energy costs do increase, that will obviously have upward pressure on inflation, at least over the short term. So not going to make that complicated situation between inflation and employment any easier, at least on the short term. When you think about the week ahead, do get some labor data. Again, going back to that inflation versus employment, be very interested to see what the trend in labor is. Again, employment still currently at all-time lows, which when you think about the Fed's dual mandate gives the all clear for higher rates. We'll see what they say. More importantly, though, for those folks celebrating Good Friday, enjoy the day. Markets will be closed as well. Anticipate fairly light trading ahead of the long weekend. That's also a function of the Masters Golf Tournament kicking off in Georgia on Thursday. That's all for this week. As always, happy to discuss anything in more detail. If you don't connect, have a great rest of the week. Take care.